Good morning, everyone. Welcome to our webinar. I'm Andi Gray, founder of Strategy Leaders, and the topic for today is what happens when you don't have a valuation. I'm going to make an assumption that most of you are curious about the topic for a reason, either for your own business or for someone that you know. And I want to welcome you to the webinar. I think this is a topic that most business owners look at occasionally, probably not enough, and I'm delighted to have all of you here today. So in terms of background, my name is Andi Gray. I represent Strategy Leaders. Strategy Leaders was built on research that was done at Columbia University. As a company, we've been around for 30 years. Our focus is helping business owners and their management teams grow successful, survivable, sustainable businesses, and then also prepare for exit on their terms. We work directly with the owners and the management teams of their companies on preparing for exit as well as growing the company under their leadership. Our experience crosses all kinds of industries. We've worked with hundreds of companies. You see some examples here: construction, manufacturing, distribution and wholesale, services, tech, retail, you name it. We probably had some experience in the industry. Clients for us have typically between about 2 and 30 million in revenue, and we focus on what moves the needle. So that is strategy, sales, competence in operations, skill at leadership, and running the business with an accurate set of numbers, to name a few. In terms of today's agenda, we're going to take a look at what is a valuation. It actually encompasses a lot more than what many business owners think about. We're going to look at 8 real-life situations or case studies. We're going to recap what happens without a valuation, so what you've learned through the discussion. We're then going to do a reality check on valuation solutions and move into Q&A. So who is this webinar for? If any of these items are on your radar, this session is definitely for you. If you're thinking about selling in the near or longer term, you need to know where you stand with the business. If you have a partner, a coworker, a minority shareholder, or even family members, you need to make sure that they understand the value of the business. You can use a valuation if you're looking to bring in investors or raise capital. We'll see an example of that in the cases. If you're planning to reward or transition ownership to employees, this is a valuable tool to use to make sure that you're paying appropriately. If you want to make an acquisition without overpaying, so if you're on the acquiring side rather than the selling side, and if you're not sure what your business is actually worth. That last one I want you to really think about, because here are 2 uncomfortable numbers. Up to 98% of business owners don't actually know what the business is worth, even though they think they might know. We're going to dig into that a little bit more and what drives that. And up to about 80% of the deals that get attempted out there never actually go to close. So they get started, but they never finish up, which means that the seller leaves opportunity on the table and the buyer misses out on opportunity. And we know that a missing or weak valuation is one of the biggest barriers to success in terms of these 2 uncomfortable numbers. So what a valuation actually should be is not just a number, but a tool. And I will tell you, I have seen valuations that have been emailed to owners and it's a number on a page. That's crazy. There's no way you should be doing that. A valuation is a fact-based statement of what your company's worth, backed up with detail. It's a look at the majority versus minority value. So that may be a new concept to many of you, depending on whether you have 51% or more control of the business or under 50% of control. And it also should present the person who's doing the valuation or getting the valuation with various exit scenarios. It should include a forecast that uses defendable data gathered during the valuation process. It can be a foundation for negotiation for both buyers and sellers. For the owners of businesses, it can be a reality check. And I find very often that the owner goes, "Oh, I thought I was worth more. Now what do I do about it?" And it becomes the tool to get to where the owner wants to be. It is a way to reward employees and partners for what truly matters. We're going to look at an example of that. And ultimately, it's a measurement tool for the investments that an owner is going to make in the business and the growth decisions that an owner is going to pursue as you use the valuation to forecast what might happen under various scenarios. So who does need one? More people than you might think do need a valuation. Obviously, buyers and sellers of businesses, but also estate planners, family members, shareholders in the business, including employees who might be future shareholders. And it also, obviously, we're going to focus focus today on business owners who want to set a price to sell shares to employees, family or outside buyers, access capital, plan or prepare for an exit, make an acquisition without overpaying. That's the big key set of words there. Track strategic growth value over time, file a tax return post-sale, and also obviously do a roll-up or increase the size of the company through acquisition, which is also a case we're going to look at. Let's get into 8 real situations and what happens when the owners did or don't have data. In the first case, the seller wanted to hold firm, so they were clear about who they wanted to sell to. They wanted to sell to an industry leader that they were already working with, and they wanted to get a premium price for the business. That's what they came to us with as a case. Unfortunately, the buyer was known for using due diligence process to knock the price that had been negotiated down significantly. So what we did is we cleaned up the owner-related expenses and question marks. We built an accurate financial history, organizing revenue, cost of goods sold percentage, gross profit percentage, and net operating income dollars and percents, which is what the buyer is actually really interested in as a starting point, because that's what they're going to use to buy the business. We produced a 3-year forecast based on proven financial results and a map forward. We used our dashboard to show the seller and the buyer, and ultimately the buyer, the performance of the business, the interrelationships, and also the opportunity for leveraging those interrelationships. And we provided a fact-based valuation that the seller could use in negotiations. The outcome was the seller started by negotiating an LOI, a letter of intent, that was 30% over market. It was possible to do because this buyer was known for starting high and then negotiating downward. So we got away with that one. But then what was key is we survived the buyer's due diligence challenges. 100% went in the favor of the owner. And because this was an upstanding buyer, they honored the original valuation, and the seller ultimately got paid 30% over market, which was unusual and not typically done with this buyer. Case number 2 was a family buyout. This was a minority shareholder, family member who wanted to sell the business, and other family members who were willing to buy that seller out. But the minority shareholder was demanding a high payout, and the buyers needed to know if they should push back on the pricing. So we prepared a valuation to assess the seller's demands, but we didn't stop there. Because this was going to be a tough negotiation using minority discounts and a lot of risk factors that were involved in the business, we brought in a second firm, turned our valuation and all of our paperwork over to that firm, and they then calculated the value, which we had already done, but they were then able to confirm it and put more depth into the discussion with the value at minority discount and risk. And as a result, the client, because we had done so much legwork, the client was charged about half the market cost by this second firm. And an in-depth report was then existed to withstand multiple seller challenges. So that went to both the seller and the seller's legal counsel and another team of advisors who backed off on the original challenges that the seller had presented because of the depth of this report. Now, we also did advise the client on negotiating strategy and use the valuation to control the negotiation and finalize share price. So it's just that's what's in the valuation, and here's the documentation to prove it, is basically the position. The outcome was that the buyers, using minority discount and risk calculations, lowered the share price by about 40%. That saved them hundreds of thousands of dollars, and the seller ultimately agreed to close within the buyer's price range. Just amazing outcome for the buyers. In the next case, we had 2 partners who were in dispute. The ownership of the business was 50-50, so nobody had control, and we had to resolve this contentious ownership dispute so we could help the client move forward. So what we did is we prepared a valuation, and in this case compared it to the operating agreement, which did have terms and conditions for pricing the value of the shares. And we were able to show the buyer and the seller where the business sat relative to the operating agreement and the value of the business. We worked with this buyer's legal counsel to build a negotiation strategy to deal with the seller and the seller's legal counsel. We forecasted and finalized valuation for the following year. So this was going to go on for a long time. Everybody knew that, and we needed to take into account the future of the business under a variety of conditions, and then ultimately convert that with very little effort to a final valuation once we got around to the close, and they were able to use that for tax filing. We helped the buyer gain control at a distressed price because of the calculations we were doing, and built a rapid turnaround plan that the buyer could use post-purchase and implement day one of the acquisition. So the outcome is the buyer and the legal counsel were really confident about the numbers that they were offering. They were able to force the seller's legal team to negotiate, which was not where they started out. The buyer consolidated ownership, so they were able to get the 50% ownership back, so that they now had complete control, and then they were able to use some of those shares to reward key players while the buyer maintained control over the business finally. And within a year, the buyer had implemented the plan that we had helped them prepare for post-purchase turnaround, and they had enough cash in order to make choices where they could choose to pay off the 5-year loan. They actually decided not to do that because they had a good interest rate, and instead used the cash to put it into the bank for safety and security, and also to invest in growth and development in the business. Case number 4. This is a partner who wouldn't let go. So again, 50-50 ownership. Neither partner had control. Neither partner could force a decision. We had to exit one partner fairly while protecting the business and the relationship. So it was really important because the partners had a long-standing personal and business relationship. One wanted to retire and was having difficulty letting go, and both of them wanted to come out of this negotiation being able to maintain their personal relationship. So we prepared a valuation. The valuation actually showed that the business was worth about half of the seller's proposal. And so we quickly dug into what was driving the seller's proposal and talked through with both partners their goals, what makes a good deal, and the importance of compromise. And through that, we realized that the seller was talking about what was needed in order to retire successfully. Whether it had any relation to the value of the business was not the concern for the seller. We did identify ways to increase the seller's outcome while we controlled the purchase price, and we then worked with the buyer's advisors on the best way to craft a deal to meet both seller and buyer needs. And as a result, we got a deal that both partners could live with. The buyer had control, or does have control, and got it at an affordable price that they could afford to finance and move forward on the deal. And the seller got to stay on for close to a year, making extra money in salary and interest, training the buyer's children on things they needed to know about the business, and increasing the seller's confidence that the business would continue, which was really important because the seller was going to get paid out over time in order to earn interest on the deal that was being financed. Case number 5. This was an investor who was targeting a market. So the goal was to buy multiple businesses in a specific geography and industry. So essentially a roll-up. What we did is we worked with the buyer on a targeted list that they shared with us, and together we set priorities based on optimal size and risk factor and the likelihood of gaining possible outcomes based on what the buyer already knew about the industry and the candidates. Then we approached each seller prospect and made an offer. The offer was that we would pay a portion of the valuation up front, and the seller would have to pay the other portion of the valuation, and if a deal got done, then the seller would be compensated entirely for the valuation. Most of the people that we approached agreed to do a valuation, and once we got valuations done, about half of them surfaced real buying opportunities. So we were able to get a lot of data on companies that were potentially up for sale, and then craft that data into picking the choices that were going to make sense for the buyer. The outcome was that we were able, with the candidates that were legit, to close deals within 3 months. That is a phenomenally short period of time, but because we were working with both buyer and seller through evaluation, we had fact-based data and sellers that were at the table ready to go, and a process to close those deals quickly. We got the deals done at valuation price with no surprises, and the buyer got a company started in an industry that he knew, so he had enough market share to be credible, and he was able to secure financing that worked short and long term, because as he was looking at each component of the roll-up, he was able to share that data with the financing organization that he was working with to make sure that they were okay with the financing that he would need to get each individual deal done. Next case is a long-haul owner. This was an owner who was looking to meet personal financial goals over 5 years. They were working under tough market conditions. So this was an historically good industry. It was in a tough situation at the moment, and the owner needed 20 to 25% year-over-year revenue growth over 5 years in order to meet their financial goals long term. Now that's a significant growth rate, and so we helped the owner look at organic investment and acquisition strategies to achieve those goals. What we did is we used the valuation of our company to decide what to do next. We played what if options for investing in the business. We used real data on competitive expectations and used that to set KPIs or key performance indicators for her business. We tested organic growth outcomes versus acquisition cost and outcomes and played out the return on investment over time for both scenarios. We were able to educate the owner on present and potential future values so she could see what the risks that she was going to be taking would look like in the future, and we shifted to using valuations as a tool to do acquisitions. So she had started out committed to organic growth, but through this process started to see the value of acquisitions under the right set of conditions. The outcome was that the owner knew why and how she would scale the business. She realized big gains and was confident about investing in her future, and as a result of that, through both organic growth and acquisitions, she was able to build a stronger team, which was actually really important to future success. She was able to achieve greater profit margins. She added more sustainable business sectors to the business through acquisitions, and she had a significantly greater peace of mind as to what she was doing and how she was driving the business forward. Case number 7, so we're in the home stretch here. We have 2 cases to go. This was all about rewarding employees, and the goal was to build a compensation model that tied real value creation to how employees were compensated. Unfortunately, as we started into the process, we found that employees were focused tactically, and they were really missing the big picture in terms of what was going on and how they played a role in terms of moving the needle. So what did we do? We used a valuation and our dashboard to put employees into the conversation. We talked about what drives company value, how they could be compensated for value-driven results, and showed them why managing just a P&L and a balance sheet was causing frustration both for the owner and for the employees. And as a result of these tools, which are all fact-based now, the team began to think strategically, not tactically, and they had better data to work with to understand the choices that they were going to be asked to make. The outcome was that we changed the employee focus from producing revenue and managing profit, the things that they had been compensated on prior, to building real bankable value that was worth it for the owner long term. And as a result of this, the owner is now considering an ESOP, an employee stock option program, where the employees will have real skin in the game. If you're not comfortable or confident about what an ESOP means, please get in touch with us, put a question in the chat window, or ask us to talk with you, and we would be happy to talk with you further. We are huge advocates of building ESOPs under the right set of conditions, obviously. And that brings us to our final case, which is a capital raise. This was a really interesting project to work on. The owner was looking to expand the business rapidly, both geographically and in markets, with outside equity and debt funding, so bringing in outsiders to invest in the business. We started out by producing a current state valuation using market data and actually a prior valuation that the owner had us produce a couple of years earlier. So we now had a lot of data to work with, and in this case we started incorporating minority value discounts because the owner had already brought in some partners to the business who did not have majority control. And it was important that all the current partners understood what the impact of minority versus minority ownership meant to the value of their shares. We then modeled the addition of new locations and new businesses and forecasted the company value with adjustments for risk factors as the company grows. So it wasn't just a straight line, add this and that'll happen. It was also factoring in risk for the number of additional locations and additional businesses that they were taking on. We did prepare a 10-year model to present to potential investors. So here's how the business scales. And we helped all of the partners in the business currently see the outcomes versus speed and risk. As a result, the owners had a credible, investor-ready story that was backed up with real numbers to present to potential investors. And the partners were all on the same page, ready to grow rapidly. They hadn't been there when we started, but they were now ready to limit their downside risk as they grew rapidly. They were confident about pursuing the capital raise. They had a concern about how much control they would have to give up, and they reduced that by reducing the likelihood of giving up too much control. They were unified in their approach, and they balanced negotiating for debt versus equity funding. So we helped them also see where the money would come from and how that would play out over time in terms of the value of the shares and the outcomes for the partners. What goes wrong when you don't have one? Here's the recap, and we're going to take a look at the outcomes that we've been talking about and why the barriers and dealing with the barriers isn't good enough. So why don't owners get valuations? The reports are misfocused. They're looking at how the numbers were revised, not how to use the numbers. Owners avoid valuations because of the cost to prepare and the concern about yielding limited usable information. They are concerned about the effort that they'll have to go through and the time it will take to assemble documentation. They're worried about a lack of available or accurate data, and they also believe that it's not necessary because they can run something on the back of an envelope. So what those barriers actually cost them is retirement plans that don't work. So we saw a couple of cases here where owners were coming to us having an idea what their business was worth, but not being able to validate, prove it, or use it in the planning process, and not getting the outcomes that they wanted for their retirement plans as a result. We find that negotiations go off track and stay off track because there isn't good data at the table for both parties to focus on. The deals that don't deliver then happen that don't deliver expected outcomes because there is a poor understanding of the numbers of what's in the valuation. We find a lot of times buyers end up overpaying for shares or acquisitions or getting their price knocked down if they're sellers in the due diligence process. So those are the things that you really want to avoid. And in terms of what goes wrong with evaluation, first thing that we see most often is for too long, the sellers play the tax avoidance game, which destroys value in the business. And this is why looking at the value of the business in evaluation helps business owners to find the balance between tax avoidance and ultimately building real saleable value. They find that the historical data being used is wrong. The revenue is too low and the expenses are too high, and they haven't been adjusted appropriately. That takes knowledge of how to build the valuation and how to document what's going on. The value guesses are way off. So on average, as I said way back in the beginning, the owners value their business typically at about 150% of reality. They get into negotiation and sales situations and they don't get anything near what they expected. We also find that owners get bad advice on how the valuations are calculated, and they get benchmarked against the wrong peer group. So the example I like to use is you're preparing a valuation for a limousine company and you benchmark it against a taxi company. You're just not going to get the value for the business that you should be getting. We also find that owners run out of time to fix what's broken if they don't get an evaluation early enough. It does take time to get the value you want, make sure that you know what you're heading for and what you're going to have to fix. The business gets overlooked as an opportunity to build asset value for the seller. There's a weak or unsuccessful negotiation position due to wrong or undefendable assumptions. The buyers overpay and the sellers give away too much. Owners miss the mark. The real reasons. Most personal wealth for most business owners is tied to the business, but the owners don't track it that way. They don't look at the business as an asset that has to increase in value year after year. They don't understand how the game changes from running a business to selling or buying one. They don't look at buying one as a strategy in the process of getting ready to sell. And they're too busy with the day-to-day business, running of the business, to see the picture. So they're down in the tactical weeds as well. The focus of the business stays on P&L performance instead of long-term value creation. They stick with organic growth and miss out on adding real acquisition value. Oftentimes I see the owners are relying on the wrong advisors to help them get done what they need. So the reality check, go back to where we started. Up to 98% of businesses don't know what their business is worth, in fact, and up to 80% of deals attempted don't close. The question is whether you need the data and whether you'll have it when you need it. That is, early enough to do something. And if you don't have a valuation already, you're not alone. But today, I hope, is a wake-up call for you to do something about it. What a valuation does for you, it should be a fast, affordable way to baseline and then ultimately update and map or forecast a company's value. You want to understand majority versus minority value and understand how to negotiate value if you're selling or if you're buying. You want to test the assumptions you have rather than going on urban legend. You want to forecast outcomes under varying conditions and know where you stand before you're at the table, either as a seller or as a buyer. So what can you do next? We've got a valuation for you. It's built for privately held owner-operated businesses. To establish the baseline is a $3,500 one-time charge. Annual updates are $1,500 if you want to keep using the tool year after year or periodically. It is an easy data gathering process, and we can turn a valuation around once we have all the data within 1 to 2 weeks. The system does follow NACFA standards, and it provides 4 situational values. So you can now look at outcomes under various conditions, whether you're going to sell the shares or just sell assets or get involved with an equity investor or just liquidate the business. You're going to have a lot of choices as to what to do with the valuation that you have. And then we will include in that $3,500 any revisions, so we don't look at it as one and done. We look at it as put data in, discuss it with the seller or the buyer, and go through revisions until everybody's comfortable with the numbers. And we do provide consulting advice. It comes from us, growth experts. We know what it takes to grow a business, and that's an all-in-one fee, $3,500. So we're telling you, know your number before you need it. This is a minor cost when you look at the value of what you're creating in your business. And with that, we're going to go to Q&A. So I'm going to turn it over to Robin at this point. We can play Stump the Presenter. Robin, what have you got for us?
Yeah, give me 1 second. We got a couple good questions. You mentioned that owners overestimate their value by about 150% on average. What am I probably getting wrong about my own number?
So it's not just a simple calculation of revenue times a multiple or net income times a multiple. And there are a lot of factors that cause a valuation to differ. It could be the expenses that the owner is loading into the business. It could be the revenue that isn't showing up. It could be the owner is calculating revenue that isn't going to be tracked because it's not on the tax return, for example. And it also is a multiple is a function of risk and equity ownership. And that's not something that most people are talking about when they're trying to do a back of the envelope calculation. So again, when we do valuations, we started out doing valuations manually following NACFA principles. We found it lengthy, laborious. It would take us days and weeks to get through calculations, and they were error prone, even using a standard formulation methodology. Because of that, we went and looked for a data-driven model and found one that had been built by one of the authors of a lot of textbooks on valuations following NACFA principles that makes sure that the calculations are right and takes in hundreds of calculations that need to be run in a database that gets proofed for accuracy and that is also benchmarking the company against its peer group geographically, size-wise, and industry-wise.
Great. I know I'm pretty involved in the day-to-day of my business. How much is that actually hurting my valuation and what can I do about it?
That's pretty normal for business owners. It's how you started the business and it's how you continue to run it. Again, I like starting with a valuation when I'm talking with someone because it gives you a baseline. Are you off by a lot? Are you ahead of where you thought you were going to be? Find out the facts of where you are, and then let's talk about where this business needs to be. Now, that may include get with your financial advisors, for example, or family members, looking at the portfolio of the business as a tool, as well as any other assets that you have.
Okay, perfect. What should I have in my operating agreement right now so that a future buyout or dispute isn't as painful as some of the cases that you talked about?
I think the operating agreement should require a valuation that is done following NACFA principles by a qualified or using a qualified valuation system. And rather than stating a formula that it's X times revenue or X times net income, that doesn't really solve the question. And in the case that we were talking about here, what we found is that the formula had a lot of interpretation open to it. And what you want to do is you either pick a firm, or if you're concerned that 20 years from now that firm may not be available or doing what you need, at least cite that there is a qualified valuation system that's used to create the valuation, and that the seller and the buyer start by having the company pay for one. This is another important requirement. And any additional valuations beyond that one are paid for by the individual party, because that was also something in a couple of cases where the individuals that were contesting the numbers were willing to ask for more things as long as they didn't have to pay for it. But once the rubber hit the road in terms of what it was costing them, that's where they started backing off.
I have two more. So my financials are a bit of a mess. Owner expenses are mixed in, bookkeeping that's not consistent. Should I clean that up before I get a valuation, or is that part of the process?
That's part of the process, and that's actually something that we'll help you with. A lot of times when we get into starting to do evaluation, we find that both what's in the P&L and the balance sheet, what's on the tax return, there's a lot of questions, and we'll go through those questions with you as we're preparing the valuation. We'll ask about where expenses sit and what the owner is paying for that may be kind of on the edges or not anything that a future owner would have to pay for. And we start adjusting that out in order to increase the profitability of the business.
Great. And then the last question I have is, and you actually talked about this, but I've been working with my accountant for years to keep my taxable income as low as possible. I'm running expenses through the business, that kind of thing. It's been great for taxes, but what does that do to my evaluation when I'm ready to sell? And is there a way to fix it?
Okay, so it depends on how much time you have until you're ready to sell. Our advice would be at least 3 to 5 years before you're ready to sell is get over yourself and start paying taxes on the profits of the business. You don't build equity in the business without paying taxes. Now, what you'll find is that you actually start coming out ahead. So one of the things that I like to caution owners on is that every dollar that you spend that you didn't have to spend, for every $3 that you spend that you didn't have to spend, you would have only paid $1 in taxes. And you would have saved $2, which could have gone straight to the bottom line and gone into your bank account or gone into shareholder distributions. So the tax game is seductive in the beginning. It looks like you're coming out ahead because you're not paying taxes, but in reality, you're overpaying for expenses and you're ending up with a business that has little or no value. Shift the game, try and do that a minimum of 3 to 5 years before you do it. Take a look at using evaluation to compare what the outcomes would have looked like under tax and non-tax situations, just so you have more data to better understand what would happen for the next year. get a valuation done early on in the year so that you can then change your assumptions as you go through the year, and then finalize your valuation close to the end of the year so that you can give your accountant advice on, I want this, but I don't want that in the P&L when I get to closing the tax return for this year.
Ugh, and it is absolutely so frustrating when you're putting all this work into your business and then you get that valuation done and it just feels like kind of a gut punch a little bit.
Yep, I would agree with that. It also, I think most business owners do not spend enough time looking at their balance sheet. They don't really understand it. I get why. And that's something that we work on with our consultants a lot, is understanding how to use the balance sheet. But if they do look at the balance sheet, oftentimes they'll see that their equity is either negative or close to zero, and they don't understand what that's doing to their long-term saleable value of the business. And that's a shame, because you work your whole life in order to build an asset. It's kind of like having a house that you lived in and you never did any repairs. You just let it deteriorate around you. Whatever you paid for in the beginning, it's worth the same or less when you get ready to move out. You don't make any value on your house. Well, this is the same sort of thing, except that a business is the most leverageable asset that a business owner owns.
So that's all the questions we have, but I think we should probably talk about how long it takes to get a valuation done with us and what we need to get started to do that.
Okay, so we need 3 years of tax returns. We have a brief questionnaire that we're going to ask you to fill out, and then we'll probably come back to you once we get that data with a couple of additional questions that either you or your accounting firm can answer quickly. It'll take us, once we have all of the data, it will usually take us 1 to 2 weeks to prepare the valuation, and then we'll get on a conference call. Conference call will usually last an hour, hour and a half, to go over the first pass of the valuation, what's in there, answer your questions. If you want your advisor sitting in on the call, that makes a lot of sense to us, and we'll take a look at what's in there in terms of data. We have a data table for you, so you'll be able to see what is driving the data or what is driving the valuation and question it. We encourage questions. We'll finalize the valuation based on adjustments that we all agree to, and then we'll produce a final report for you.
That sounds great. And that's it. All out of questions.
Okay. Well, thank you, everybody. I really appreciate your interest in the topic. Evaluation is a tool. It is something that you can use to develop the success of your business. And I really encourage you to pursue one for your business so you better understand where you stand. Thank you all for coming today. And thank you all for learning something today, I hope, from Strategy Leaders.